Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on this edition of Conversations, we're joined with Chase Taylor of Pinecone Macro Research. So we're just gonna, get it going. We're gonna have Chase introduce himself, give a little bit of a background on what Pinecone is, and then we'll get right to it.
Sure. So Chase Taylor of Pinecone Macro Research is just a macro research firm I started a couple years ago. Kind of work with everything from institutions, hedge funds, down to just people trading at home. So I have a couple different price points to let people in, whether they're retail traders or high end. I just kind of hit on everything. I'm kind of a traditional macro guy, so a mile wide and an inch deep. That's about it.
Nice. It's always fun because the joke is, if you ever want to talk, find someone who has an opinion, just ask someone who is a macroeconomist, and they'll formulate something, whether they know it or not, and it'll sound good. Use some nice words about it. So the interesting thing that has come out that we were just talking about is the 20-year and 30-year offering. We've seen we saw the softness come into the 30-year, and then that was replicated again in the 20. We were talking about inflation and kind of what this means for the real yield. I mean, what are some of your opinions on what's your takeaways from what happened?
Yeah, you kind of divide this out into kind of what's going on short term versus long term. I think if we look at it long term, real yields are going to have to be very negative for probably a very long time, just because of the debt situation and the amount of fiscal spending that's going to be necessary to kind of keep the economy afloat. But short term is starting to look like, real yields are starting to move a little higher, and as well as nominal yields out on the like 2030, like you're talking about. So right. the curve's steepening a little bit. It's starting to already mess with some asset prices as we're able to see. Long term, I really don't think that can stay that way. But right. Short term, we can get some big pullbacks in things like precious metals, which we've kind of seen already.
Yep. So you bring up a good point when you look at duration. So when you're looking at the duration risk, you're definitely seeing that steepener. I mean, when we start looking at some of this, then at the same time you look at the Bund, and the Bund had a relatively strong setup. I think it was actually it was the strongest ever, or one of the strongest ever. Is there a breakdown that you're seeing or that you're feeling in terms of like the US dollar versus the euro, or is this more of like a short-term shift because the arbitrage opened up between the two? Or is it something more sinister or bigger when you look at the dollar overall?
Yeah, that is absolutely the $1 million question right now. And, from a technical standpoint, when you look at the chart, it's right at make or break level at the moment. Kind of the 93, high 92 area, like on a monthly chart, that's the uptrend line. There's a giant horizontal line at 93 that's kind of everything right now. Mm-hmm. And we're just kind of in a battle royale there. There's really big forces kind of fighting within all that. Obviously the dollar trades against other currencies like the euro. It's hard to get bullish about some of these other currencies, just looking at their own macro situation. But at the same time, with the shell revolution being what it has been for really the last decade, that's been a nice tailwind for the dollar to move higher. And kind of relative production for the U.S. is going to probably be a little bit lower compared to the rest of the world. I would assume for the next few years, it's going to take shale some time to really come back, and right. that we're exporting a lot less dollars that way. So that should be a problem for the dollar. Mm-hmm. But lately everyone's gotten really excited about the fiscal situation in Europe, and I think that was very politically relevant, but not that economically relevant. But hey, so far the market loves it, so you got to kind of listen to what the market's saying. So at the moment, it's really difficult to have a firm view of like what comes next on the dollar. Everyone's on the short side of the boat right now. Everyone's long the euro. People love the yen even right now. But at the same time, like you can see why some people expect the dollar to move lower. So right. You sort of have short-term positioning versus what may be some kind of new secular forces for the next decade.
Mm-hmm. Yeah, it's interesting when you start breaking it down like that, and you start looking at. I think the number was there was 96 currencies out of 146 still depreciated against the dollar, even as the dollar was falling. So now you have a situation where the dollar's going lower, but everything else is going lower with it. To your point on some of the economic impacts abroad. And when you start looking at the macro trade, if you will, where people were starting to say, okay, well, let's look at this versus gold versus oil versus dollar. And you have a lot of guys just saying like, press the dollar, start buying oil, start buying, some of the gold assets, and now the unwind is here. Is this an unwind that gets more aggressive? Because even oil never really moved. Like, the supply level of oil was always going to be the headwind. The demand was never really there, even though that was part of the trade. Is this going to be pressure where you get to see the dollar move and oil start to kind of crack under the pressure of an unwind?
Yeah, so that's kind of the way I'm looking at it right now. Short term, the dollar can get a nice little bounce. And things like oil can crack and get a sizable pullback. And then we probably get to a spot, let's say that does happen. If we get to a spot, 2-3 months down the road, and say the dollar's kind of taken out all the people that were shorting it, all the people that just got long oil because it's, been doing okay for a couple months, or, they're betting on a big reflation and global growth has already, bottomed out and everything's going to be okay. Once that kind of runs its course, then you get to a point where, like, I don't think anyone's going to have a really good idea what comes next. My feeling is the dollar is going to move higher. Things like oil are going to have to trade a little lower. And this kind of reflation trade that's been working really since the bottom in March may kind of unwind here for, I don't know, 2-3 months, and then you kind of get a decision point. And at that point, then I could see the dollar kind of rolling over for real. With the secular forces kind of taking over, and then oil just on the kind of supply fundamentals that are kind of longer term. In short term, like you say, the demand's a pretty big problem. Obviously, supply is still really high, but I think if you look at all the capex destruction, and it obviously we're going to move higher in the future. So it would kind of make sense if that matched up with the dollar rolling over 3 to 6 months from now.
Right. So looking at the inflation or the reflation trade and trying to weigh the different sides, before we go abroad to Euro, I'm interested in your take on the different market forces, if you will, looking at this. Because you look at housing, you look at the RIP, you look at lumber going limit up, 30 out of the last 60 days. Yeah. You look at some of these things, but then at the same time, what is it? Another 1 million people unemployed this week, above estimates. Right. You have people that are going to start seeing pain as the fiscal, payments have stopped. And so while you have the inflation, you also have some of that deflationary pressure, and diesel's helping you. The worst thing we could have right now is $3.50 gasoline and $4.50 diesel, because then that would blow everything up. But kind of in this level, we have some inflationary pressure, some deflationary pressure, and then the Fed pumping in as much M2 as can possibly be thrown at the market. What is kind of your take on what wins out over the next, call it, 12 to 16 months?
Yeah. So you frame that well, because that's a lot of people are, really bullish inflation right now. And to me, everything we're getting there is kind of transitory. It's idiosyncratic, like you're talking about with lumber, right, where the mills, they're getting bottlenecked. So it's spiking lumber futures, but if you look at the contract for a year from now, it's like half of what the front month is right now. Right. Showing you it's more just a temporary supply problem, not a real issue. So, and I think there's a lot of that out there. We've seen it with meat prices or egg prices because of the pandemic. But all there will be a supply response that takes care of those things. So I think short term, most of this inflation is not much. The Fed looks at core PCE, and I think it's at like 0.9. 0.9. So the Fed's not, obviously not at all worried about this. But at the same time, that's where you get the seeds of inflation, a year and a half from now. It's not 18, 16 months you're talking about. So yeah. I think we're already planting the seeds for that, because the Fed's not doing anything until, we get back to unemployment at probably 2-3%, and inflation's running more like 4 or 5 before they even get nervous. I would suspect, because I think the reality is they want to try to inflate a lot of debt away, because that's such an overhang on the economy.
Absolutely. So taking that to a different level and looking at the growth of monetary supply, but then there's no real velocity, and it's all getting bottlenecked at the banks. You have bad debt expense that's increasing, so they're keeping more to shore up balance sheets. You see the loan requirements going up, the unwillingness to lend, and so even though it's going into the market, you're not seeing it really kind of flow through. Have you looked at or considered like what could a change in entry point look like if they would even consider it, just given kind of where those backdrops are, as we've seen velocity come out over the last 10 years as debt has increased and the debt bubble is like an overhang almost, and we could unlock some of that velocity?
Yeah. And like, I don't even pay attention to M2 because of that. It's just, to me, that's sort of a waste of time. People have been watching that for years. All that matters is getting money into the hands of people that are going to spend it. Right. And that's where the pandemic response has kind of changed things, because a lot of the early fiscal response was, mailing checks to people or giving them, basically a giant unemployment bonus. And, I think you get a taste of that. You get a taste of that MMT, and you don't see, the inflation response. You start thinking like, oh, well, we can do that. Mm-hmm. And I think this goes back to QE. You did QE and everyone thought you'd get hyperinflation, and you got zero inflation or a little bit of inflation. So, the more you do projects like that and the more you get away with them, meaning you don't get an inflationary response, the more you think you can just go crazy with it. So I think they will go crazy with it. Right. So, but that's really what this comes down to is, does the fiscal response, the helicopter money type response, does it just go away after the pandemic? Is it just an inflation or just an emergency only, break glass in case of emergency thing? Or is it become, hey, like that's a good way to get votes and it doesn't cause inflation, so let's just do it. Right. And that's where my money is that we'll keep getting more and more of that fiscal stimulus, MMT, if you want to call it that. Mm-hmm. And I think that will generate the velocity at the end of the day, and we will get real inflation. Right. Above trend.
So when you look at like the 30-year and you consider the fact that the amount of just the number of bonds that have to be issued from the Treasury just continues to increase, not only because of the stimulus you're talking about, but also the tax shortfalls. Do we start to kind of see that crack just in terms of the sheer size of borrow before we actually get to the drunk with money and just, see how much we can push it? Like, is there a market force that adjusts that kind of ahead of schedule before we see that people just printing blindly?
As long as the Fed's there to mop this stuff up, I just don't see how. I mean, you can get small dislocations, right. And honestly, I don't think they would mind if the 30-year backed up a good bit. They could help the banks out to really steepen the curve, and that becomes sort of your, basic income for the rich is to have the 30-year yielding, 3-4% while the 2 is doing nothing, because then you can use treasuries as a hedge again. You can, use treasuries for income again. So I don't think they'll worry too much if the 30-year were to back up. Now, obviously, they'll want clean auctions. They'll want the market to function. But if the yields move higher on the back end, I don't think they'll be too concerned about that. And okay. I would say some people would even see it as good. Mm-hmm. But as long as they're there to buy it, I don't see any problems.
Right. Now, when you look at, you talked about shale and how it's kind of benefited from this essentially cheap capital, and you start to see some of these risks coming back in. I mean, what do you look at when you're looking at some of the majors where they have these long life assets? When you're looking abroad, like Chevron, Exxon, some of the big guys, do you start to value them a little bit differently as you start to look out to see kind of what their resources are, what their ability to find new resources are, and how they kind of compete, because obviously energy has come under a lot of pressure, and kind of what that looks like on the back end?
Yes, and I'm bullish oil long term, very much so. Mm-hmm. I think the next few months could be iffy, but whenever I do go out and I want to find, I'm a macro guy, so I'm going to trade oil futures first and foremost. Right. But I do want to own some of the companies, and whenever I go look at those, I'm naturally kind of gravitate to the majors because, or I used to. A lot of them got pretty involved in the shale space, which frustrated me because I've always been really concerned about shale. Yep. But at the same time, that they're able to get credit, a little easier than some of the smaller players. Mm-hmm. And that's going to be really one of the big issues in shale. So whenever I go out and look for oil and gas investments, I'm looking for minimal shale exposure, a balance sheet that can make it through the next couple of years, no matter what happens. And like you say, like I want somebody with a bunch of resources, and What's going on now is a lot of them, they seem to be discounting their own resources. They seem,
Right.
We're hearing out of Europe, some of the big oil companies are, they're saying like, oh, we may never get that stuff out of the ground. To me, that's crazy. And that's a great sign that, we're near a great bottom in oil, on a long run basis. But
now, when you're looking at some of the adjustments, when you're talking about some of the majors, specifically some of the ones out of Europe, they've talked about getting rid of or getting out of refining, and that was always kind of like the saving grace. Where if you were losing money on the E&P, you could make money on the refining side, control the full chain. But now you're starting to see what seems like a cap in terms of refined product demand, and we saw it before. This is not a COVID comment. You started to see some peaks last year. Do you think that's something where that'll over the longer term cause an issue with oil demand, or is it something where it's just a great opportunity because, like you said, they're discounting their own value, and there's still a significant amount of value to come out of the downstream refining petchem space?
Yeah, I think it's the latter. I think there is still a lot of value there. I think it may take some time to play out, but a lot of it is I don't think they understand the value of their own. But at the same time, like a lot of these, a lot of them really want to sound as green as possible right now because of the environment. So I think if they could say, look at this green stuff we're doing, and oh, that giant field, we may never even use that. Like I think part of that's a narrative game of trying to look good for the ESG type crowd, but
right. So when you're looking at it from the ESG side and you play the game, where do you kind of value that natural gas side, and what do you see for natural gas in terms of, some of the staunch ESG is like, it's a bridge fuel, it's going to go away, or my opinion is it's part of the basket. Like it's just a long-term great basket, clean burning, viable, can be moved around pretty relatively easily, just like LPG. I mean, what are you thinking in terms of natural gas? Because even though, they've gone green, they've talked green, but they've also talked natural gas. And you've seen a lot of investment across the natural gas space, specifically Shell, BG, and kind of how are you factoring that in when you're looking at some of these long-term assets?
Yeah, I'm incredibly bullish nat gas now and into the future. And I think it's going to be part of the answer. I think, politicians will make it sound like it won't be to please the green crowd. But I think, even in the US, you look at Joe Biden's kind of said one thing, but also kind of meant another thing when it comes to things like gas. It's part of the answer. I mean,
right.
If gas replaced all of coal right now, the amount of emissions it would save is just huge.
Yeah.
I think, whenever coal is gone, whenever coal's not generating any electricity anymore, then I would kind of look like, okay, like now natural gas is like kind of on the chopping block. It's when it's the dirtiest electric production around, then I would get concerned about it becoming, a real target. But until then, and while it's still much cleaner than some sources, I think it's going to do great.
Yeah. We go through this all the time. Like I did all this work about China when you're looking at, when China had, I think it was 8 of the top 10 most polluted cities. And now they've fallen out of that category. I mean, given there's still a lot of pollution, don't get me wrong, but and it was all because they aggressively just went after coal. It was all about How can they adjust coal? How can they adjust steel production to be timely with atmospheric pressures, all that nonsense. And you start seeing this shift, and all of a sudden now you have India with 13 out of the 15 dirtiest cities. And you're starting to see, well, what happens if they aggressively adopt LNG and natural gas and really start to push that through, because they have the spare pipe, they have all this opportunity there. It's just getting out of their own way, if you will, when it comes to tariffs and all that good stuff. But just kind of shifting gears and looking at when you're talking about natural gas and you're talking about LNG and just that adoption, you have to look at the big growth areas. And when we talk about cheap capital, but then we start seeing some inflation issues in India, some leverage issues in China. I mean, what are you considering or looking at when you start to kind of focus in on, well, how are people going to invest to kind of take in this new fuel or to invest in ways of growing the economy?
What exactly are you asking? I wasn't quite following you.
So when you're looking at the inflation issue, so natural gas, you need a natural buyer. So if the natural buyer in terms of growth is Asia, and you need the investment in terms of just they need to go out there and invest in receiving areas and regasification, utilization, putting pipe, connecting
Sure.
it all costs money, but inflation is becoming an issue. You're seeing growth kind of stall out. Does that delay what you're talking about, or do you think there's going to be a bigger investment coming from the U.S. and just kind of dumping money in and trying to build out this new economy, if you will?
Yeah, I could see it going both ways, but I just don't expect a real hit to building this energy infrastructure. Mm-hmm. It's too important to the emerging world, to emerging Asia, to have the capacity to have the cleaner fuel. I think they'll, I know it's expensive, but I think they'll find a way, one way or another, to build it all out. McKinsey just had a piece recently about kind of LNG in Asia, and they surveyed a lot of folks there, and everything you see there, I mean, they also have the same big plans they had 6 months ago.
Right. And when you're looking at the shift, if you will, from in terms of supply chains out of China into some of these other surrounding areas in Southeast Asia, a lot of the remaining supply chains in China are a huge suck on the grid, whether it be the assembly of electronics, the assembly of chips, all these different components. And when you're looking at talking about kind of growth in this emerging market world and the shift of supply chain, which would be, I agree with you, like long-term bullish natural gas, propane in terms of just consumption. Where are you looking at, or what do you think would make the most sense as these supply chains start to kind of rationalize and invest outside of China?
Yeah, I mean, it'll be messy, for a little while. It's going to be kind of tough to figure out, exactly where everything's moving to and how quickly. But, as those things do move, and obviously a lot of energy, demand is going to come from those large industrial projects that are going on. But at the same time, just you kind of look at the wealth S curve in the emerging world, where you're just going to get a non-linear, response in wealth. And with that will come, a lot of electricity demand. Right. So even if it was just from the consumer side and less so from, just manufacturing, I think that the demand for energy is just going to kind of just keep moving higher. And I think we have kind of a long track record of people underestimating energy demand, So, and I think it's really hard to model the wealth S curve. Like when, places like Pakistan, India, all of a sudden kind of have a big wave that hits the middle class and, wants more beef and electricity and all those good things. It's not an easy thing to model out. So, right. But when it happens, obviously the manufacturing will follow that, because you're going to have to, supply the demands of all these new middle class people. So I think not something I'm worried about. Right.
Now, when you're looking at some of the bright spots that could see kind of the most interest, where are you looking in terms of a country level where they have maybe the best ports or the most availability in terms of labor, and where there's a lot of opportunity just looking at some of that near-term investment, or I shouldn't say near-term, over the next, call it 5 years, if you will, as things continue to adjust? Like you said, it's slow, but it's still progressive, it's still moving, it's still always going forward. I mean, what are you seeing green shoots of, if you will?
Yeah, probably nothing that's different from what a lot of other people see. But India, I think everyone's pretty well-known story, and it tends to be overvalued to invest there because it's kind of an obvious story. But Vietnam, Malaysia are a couple that are on my radar. Malaysia, right, especially, but yeah.
Yeah. Now, when you start looking at some of the balance sheets, just kind of going back and talking about some of those countries, and you're starting to see, the dollar is obviously the reserve currency. You see it out there, but global trade is slowed down. So now you have some of these countries that have to whittle through foreign reserves. You see inflation starting to pick up a little bit. I mean, what is your take in terms of that dollar shortage abroad and some of these foreign reserves maybe kind of delaying or pushing back some of these investments just because, the economy is what it is?
Yeah. So I do think the dollar shortage is a real thing. And I think it was really, about to kind of come off the rails and really break the world and create a lot of problems before the Fed stepped in with the swap lines a few months ago. Mm-hmm. And it really, it kind of comes down to how much help will the Fed, provide whenever that moment does come. And obviously they're not, not everyone gets a swap line.
Right.
So, for the countries that don't have them, it's a bigger problem. Like we're seeing in Turkey right now, they're not the beneficiary and they're having real problems. The thing I kind of find interesting on this, kind of sidetrack, but you've been seeing, quantitative easing in the emerging world after COVID. And so far they're not getting, the crazy levels of inflation that you're used to seeing whenever you get easy monetary policy there. But, if I think coming out of the crisis, when demand kind of, global growth starts to normalize, it'll be really difficult for these EM central banks to get away with, that loose of policy without getting heavy inflation. So, what their response looks like, let's call it a year from now, if they start getting, substantial inflation, like places like, Turkey, Brazil,
right.
They're going to have to either break their own economies really hard, or they're going to have to let inflation, get really ugly, which obviously either way, you're going to have political problems in those places. But so dollar shortage, real problem. It's kind of under control right now. Obviously, the dollar's been falling significantly, and the uptake for dollars from the Fed from the rest of the world kind of fell rapidly. You could see those, how much the Fed was giving out in the swap lines. It spiked, and it's really kind of back down to normal now.
Right.
So I think when people look at the dollar shortage, I think people look at it as more of like a stock problem, but a lot of times it's a flow problem. It's a liquidity issue, and whenever they can fix that liquidity issue, it goes away. But like you say, if you're drawing down on your FX reserves significantly and you're not able to replace them relatively quickly, well, it becomes more of a stock problem than a flow problem. But it's difficult to kind of figure out, like, okay, when does that actually break something?
Right. We've seen the IMF kind of step in, and for guys that have good balance sheets but can't get a swap line, then they're kind of the lifeline that some of these guys need. And we've seen, I think we're now past 90 countries that have hit up the IMF for some form of support. Now, when you're talking about some of this going forward in some of those countries that maybe don't, they don't get the swap line because of the backdrop, but they still have assets, they still have collateral, they still have something that's of value. Do you think the IMF plays a bigger role kind of going forward as we start going forward? But then at the same time, that also helps solidify the U.S. dollar as that reserve currency, even past this economic backdrop.
Yes, and if you read headlines the last month or so, you would think the dollar already lost its reserve status, which has been kind of hilarious to watch. But when I look at, so what's interesting to me is, first of all, yes, the IMF is going to have to be, play a bigger role here. But what I kind of find interesting is, I don't know how, these countries pay back really any of this IMF money. And obviously IMF money comes with a lot of strings attached, for reform. And if you're a place like South Africa that, where unions have significant power, and the biggest thing that's kind of crushing your budget is, unions, really take a giant pile of money, and if you really try to stare them down, then you're done politically. So you get these crazy situations where you have to sacrifice political stability for financial stability. You got to kind of pick one that's you're going to allow to break. So when I look at places like Turkey, Brazil, South Africa, those are the ones that kind of come to mind as, sure, they may take some IMF money, but they're either going to have to not honor the strings attached at all, or they're going to have some real political stability problems. Right.
And we all know, what that looks like when we have the geopolitical issue. Now, just touching on that geopolitical and shifting a bit, because I agree with you. Like, the dollar survives. It's, maybe it's a balance of more gold, maybe on central banks if you look at purchases, but when you look at that instability and you look at the petrodollar, you're still settling in dollars. Like you talked about South Africa, Brazil, but what happens with Iraq, Nigeria, Angola, where they just need those dollars and they're supposed to be cutting, but they really can't because they need the stability in terms of the geopolitics, but at the same time, they have a current balance, essentially. Their current accounts is just crap and they need to fix it somehow. So do they keep cheating or keep kind of bleeding in, and Saudi Arabia just keeps wagging their finger but really doesn't stop them because they know they need those dollars to kind of shore up their balance sheet, provide some of that stability. And then, looking at that, do we just keep getting cheating?
Yeah, and I would suspect that's going to be the case. And really, I think, those currencies are going to have to move officially. A lot of them have already moved unofficially, like in Nigeria, but eventually you're going to have to get an official devaluation for this to work in any way for a place like Nigeria, because, during the good times, they just don't do near enough to, take care of that current account.
Right.
I think, Nigeria tried to grow more rice so they had, so they can import less. And that's the biggest thing I could think of that they tried and didn't really help much. There was still a lot of smuggling over the border. Like it just, other than a devaluation and, real political change, it's hard to imagine them, they're going to have to cheat a little bit, and just hope they can get away with it. But yeah.
Yeah, it's funny. Like if you look at the stability on the geopolitics side, I mean, Saudi would be risking so much if they just really kind of forced it or tried to enforce it by just pumping themselves or saying they're going to pump, even if they don't actually do it, just to kind of spook them. But when you start looking at it, you talked about food a little bit. We're starting to see kind of that food inflation on some of these areas and food security becoming a bigger problem. I mean, what is your take when you start looking at some of the food issues that are starting to crop up, especially as it comes back down to inflation and just some of the issues that are arising at the emerging market level?
Yeah, food's interesting because it's a combination of like real secular, like real price changes, and then the kind of pandemic supply constraints issues, like two separate things where. Right. Eggs like went nuts but it was easily explainable because of the pandemic versus, some other staple crops where, you're having supply issues maybe overseas because of extreme weather. Mm-hmm. And, China's buying a lot of corn all of a sudden from the US, and a lot of that's because, they're having problems with their own production. So I think, and we're getting extreme weather. I think that's pretty clear at this point. And with extreme weather, tends to come, some crop issues. So in the U.S., we've been really fortunate for a long time now to have a lot of great crops for corn and soybeans, especially. We're just that close to having small hiccups really change the game, right. For the entire agricultural space. You look at, poor Lebanon after what just happened there. The talk about a food crisis, with the amount of grain they lost, it's just brutal there. So I think, I expect high inflation really the next 10, 20 years probably, just because that's kind of the natural response at the end of a long-term debt cycle to inflate away debt. Right. And with that, I think we're going to have pretty significant agricultural price shifts higher. It may take some time to really, take root, but I think we're a couple of weather events away from having, a short-term spike, and then the long-term issues are going to be just, the value of, money, going down versus those agricultural commodities.
Right. Well, you bring up a great point, because you look at the weather shifts. You had how many locust swarms that are the biggest ever. You had swine flu that culled 60%, depending on whose numbers you use, of the actual herd. You have all of these issues now with flooding, where China is interesting because in one area you have massive flooding that's on a biblical proportion, and then other areas you have droughts that you haven't seen since records were kept. And it's just this interesting shift in terms of trying to create that security. And shifting to China on that, you've seen the Belt and Road Initiative, the BRI, trying to create some sustainability and trying to push that yuan currency and really building their own economy, if you will, outside the dollar. Now you have the U.S. threatening to use SWIFT, cut them off from SWIFT, seeing some of these issues. I mean, when you're looking at it and trying to model out kind of what Chinese growth looks like, do they ever get away from the dollar? Is it something where is the BRI just going to be a failed investment that's going to cause them to really slow down as other areas start to benefit, as people just leave in droves?
Yeah, I think they're going to largely have to get away from the dollar. I think they're going to have to follow Russia and de-dollarizing their economy pretty heavily. I think it unless the next administration, assuming it's not President Trump anymore, unless they make really radical shifts in U.S. China policy, if this thing just kind of keeps moving along that way, I mean, all they can really do is start trying to push their exports out to those BRI countries.
Right.
And, obviously consuming a lot more themselves, but, the wealth just isn't there to really make that happen. So that's difficult to imagine. But, getting all these countries to really play ball with the yuan is really difficult for me to imagine, unless, they build up their gold reserves to the point to where, they can kind of settle mostly in gold. I'm sure they can, have people hold the yuan, short term and in small amounts, but is it going to be, a giant reserve asset for much of the world? I can't see it. BRI was like a really big strategic move for them because they had so much, capacity built up that they couldn't do anything with. So really, to me, BRI was mostly about exporting all that excess capacity. Just, they ran out of stuff to build, so you got to go build stuff somewhere else. I think that's the biggest thing. Obviously, the soft power and trying to build markets for your exports is part of it, but I think most of it was they didn't know what to do with all their excess capacity, so they just kind of pushed it overseas.
Now, when you look at the de-dollarization or getting away from the dollar, how do you see that working? I mean, given the fact that they use so much of it as collateral, I think it's 3.12 trillion or so between cash and treasuries. It just, they fractionalize that collateral so much. It just seems as though if they were to do anything, it would be mutual destruction. It would just, it'd bring everything down for us, but maybe the Fed steps in and buys it all and they say, go ahead. Or is it something where we just have that, the Texas stare down and we just, can't really do much except kind of wag our fingers at each other?
Yeah, I mean, the way I see it, the world's going to slowly de-dollarize, but it will be slowly. We've seen it. If you look at bilateral trade between Russia and China, they've steadily used the dollar a lot less and less. So, you look at the gold reserves versus dollar reserves in Russia, like what they've done. It makes sense and it's working for them. They are de-dollarizing, but it's slow. They do still need the dollar. So I think it'll be a slow process and it'll get to the point, because in my opinion, the dollar reserve standard doesn't really work for anyone. In my opinion, it works least of which for the U.S. probably at this point. Right. So I think we need the system to change. I think the rest of the world needs the system to change. So it will change, but typically that doesn't happen until the pain is just kind of, you can't take it anymore. And then everyone has to come down, sit at the table. And I don't think we're there yet. So I think we'll get slow de-dollarization, but the dollar shortage is going to crop up from time to time and become a problem. You'll get, even if the dollar does go into a secular decline, starting now, I think you'll get a few, one-off, just really nasty spikes in the dollar because of overseas shortage issues and, because of just the dollar debt is just too big overseas. Unless they stop borrowing so much in dollars, especially in the emerging world, then they're going to be susceptible to, ugly spikes.
Now, when you start looking at other currencies that could replicate or replace or at least become a bigger portion, I mean, where does the euro and the yen start to factor into this, or does it not factor into it? And it's just we start going into something a little bit different that's maybe more gold backed or crypto, who knows? But when you're starting to look at the short term, if you start getting those to get kind of soften some of those spikes, do you start seeing euro and yen increase in size, or maybe not so much yen, but euro, just to try to offset some of those flows?
Yeah, it's the only option. I think the only thing that can take a little market share from the dollar is the euro, and that we've seen that on a small scale in the last few years. Maybe this kind of new fiscal consolidation will help a little bit with that. I think a lot of economists are really excited about that, but I'm sure people that are invoicing, that run real businesses, maybe a little less, happy about this whole thing. But right. But I do think the euro can take some market share. I mean, it's a giant economy. If you look at the whole euro bloc, and they do a lot of trade. It's been a stable currency now for 20 years. So I do think they can take some of that share away from the dollar, but I also don't think it'll be significant because of the political issues there, the political differences, right. amongst the countries. It makes it a little nerve-wracking in the fact that, you don't have a common, fiscal or common tax authority. So.
Yeah, that north versus south, when you look at just the spending versus the saving, and it's definitely the haves and have-nots in terms of the backdrop. But when you start looking at kind of what this looks like post COVID and this, the pickup in trade and where we see some investment, we've seen copper do its thing. It's rallied, but there's always been kind of talk back and forth that it's more along the lines of supply, not so much demand, because we had huge disruptions. And now, like you said, with lumber, once you start seeing copper coming back, things kind of come back down, and it's really not a demand issue, it's a supply issue. What are you thinking when you're looking at some of these big kind of bellwethers that have been, let's just say, mismatched with supply as they start to come out and start to normalize? Like, how are you using that to kind of model where some of these countries are going, where you think real demand is, or where that turning point is in the underlying real economy?
Yeah, good question. And copper's been really tough for me really the last couple of weeks, because I've been expecting this, reflation trade to kind of roll over and the dollar to pop, even if it's only for a month or two. But the copper has kind of stayed stronger than I expected, and is even trying to break out, on a long-term basis. Right. And if you look at supply, it's not that tight. Obviously we've had a demand spike because of, huge Chinese stimulus the last few months. Yep. And I kind of took it as, okay, we got a one-off giant China stimulus, so that'll obviously help copper. But, whenever they kind of, let up a little bit on that, what is copper going to do? So I've been kind of expecting it to roll over the last, I would call it 2 weeks. And so far it hasn't, which has been interesting to me. Yeah. And maybe telling us something that I'm just not catching yet. Mm-hmm. But yeah, I think, copper has a bright future. I think global growth has a bright future. I think, U.S. growth does, but the next 2 years are probably going to be really tough on the demand side, unless you just get absurd government spending, all over the world to fill in the hole from the private sector.
Now, looking at it from the perspective of the U.S., where you're starting to see that urban to suburban to rural, and you're starting to see some of these, home starts are back up, permits are back up, and you need to run fiber, you need to run wireline to kind of source some of this. Do you think that could be kind of a sneaky, or not even a sneaky, just kind of that bigger shift as the migration goes from urban outwards, where you're just going to get a natural build out that will be this kind of base demand that's only going to increase over time, just because copper is a huge component to all of those as we kind of move out?
Yeah, whether it's just housing or green energy, there's so many drivers that are huge for copper moving forward. So I think on the demand side, copper has a really a brilliant future. And if you look long term at where supply is and where supply is likely to be on the production side, then you can see a mismatch where it makes sense for copper to move a lot higher in the future. It reminds me of oil, where if I look at supply and demand for the next 6 months, it's kind of a problem. It doesn't it doesn't look that great. But if I look 3 years from now, where is supply and demand likely to be? If I just do some napkin math, it looks really good. Right. Back to housing though, I think housing is going to be really bullish in the next 10, 20 years. Just you look at millennial household formation, and what I'm assuming is going to be a lot of stimulative policy for millennials whenever we get kind of a populist left government at some point, and you get more millennials actually in government at some point. If you look at all these polls that show how much millennials like socialism, and I am a millennial, I'm an elder millennial, but as a group we tend to like handouts and socialism. So I'm sure we'll find a way to get rid of our own student debt and things like that, and then you'll see household formation and just explode as well as just consumption from that block. Right.
Because it's been interesting during the pandemic when you see the people moving out quickly. They're ones that have the means to do it, and that's kind of the first wave, and you saw this big shock. But then you have delinquencies being delayed, delinquencies increasing, but you're not seeing foreclosures really. Kind of all that's been kicked into next year, so you get this weird kind of mismatch in terms of just supply, especially if you look from 07 to 08, you had the big spike and then you just collapsed, and we really didn't see housing starts really kind of come back until recently. So it's an interesting kind of backdrop as you start to see some of that come out, and people now, like you said, millennials are looking to move, looking to get out, looking to adjust. Now, I'm an elder millennial. I wasn't a millennial for a short period of time, and then they adjusted the age range. So I'm now officially a millennial. But just as we're wrapping up and we're starting to kind of look at just to keep it at about 45 minutes so that we don't kill our our bandwidth. When you start looking at these investments and places that you're interested in over the next, like you said, going further out, say 2, 3, 5 years, I mean, what are you most excited about in terms of places to get involved, and where do you think is the most risk as we go forward? That may be losing market share because of these adjustments.
Yeah. So the things I like is real assets, because I do expect this fiscal spending and the monetary stimulus to just be the new normal. I don't expect that to fade away. And because of that, we are going to get inflation. And because of that, I want to be involved in real assets. Obviously, precious metals are going to be an anchor for that. But oil, gas, I think they're just so unloved and hated. And yes, they have some headwinds in the near term. But when I look a couple years out at supply and demand, it's something I want to be involved in. I am. A lot of people with a similar viewpoint they just want to short stocks. They want to think stocks aren't going to go higher, which to me makes no sense. The same drivers that are going to drive these things are going to drive stocks higher too. At this point, the stocks are basically tied to national security. They're tied to this too much of what matters most to politicians. So I expect stocks to go higher, but I'd rather have real assets because I think they'll outperform on a real basis. Right. And at some point, if the dollar is going to break below 92, then we're probably in a secular dollar bear market. At that point, you start shifting some from U.S. To some good markets overseas. One I really like is Ireland, of all things. They have great demographics, high growth, and they have this weird situation where they're tied to the monetary policy of the rest of the country that that needs life support, and they don't, so that they get just a giant subsidy because they happen to be tied to the Italys and Spains of the world. And I think places like Ireland will do great. Okay.
Now, just to wrap up, just because you had made a great point in terms of real assets and just what the value is. So not only does a real asset give you, if depending on what it is, gives you nice cash flow, but it's also a pretty good inflation protection. So even if you do get that inflation, you're going to see that benefit, and then the cash, which may get discounted, is also going to be a good way to kind of backstop that. So when you're looking at these real assets, are you looking at things that are cash yielding or something that might be opportunistic on a go forward basis? What kind of the real assets that you're considering and that are really a hot commodity right now, or will be, and you want to kind of get involved in?
Yeah, so I definitely am looking for some cash yield that comes with these, and there are some situations that people don't think about. First, real estate does well when there's inflation. I think everyone knows that, but there's also a lot of real estate that's too pricey right now. Obviously, commercial real estate's having significant problems. You don't really want to own hotels right now or offices. But at the same time, you can own data centers, you can own wind farms, you can own storage. There's a lot of other options that are real estate that pay a high yield that that will work. One I really like is manufactured homes. I think people are going to look to downsize. People are going to look to save money with their housing, and I think manufactured homes are likely to do great, and they yield really well. They actually have a couple of REITs for those, and they've performed pretty well lately. That's one where you have to be willing to take some hits, at different times. But there's a lot of real estate options, forced, timber. There's timber REITs out there. There's a lot of companies that are involved in that space. They're probably getting overvalued at the moment thanks to lumber futures a little bit, but long term, that's something where you own the land and the tree gets bigger every year, so you're just throwing off cash all the time.
Right. Now, last question, then we'll let you go. When you're looking at commercial real estate, because it's an interesting backdrop as commercial real estate is doing what it's doing, and you're starting to see, I think Simon came out and was talking about turning some locations into Amazon fulfillment centers. And you're looking at bandwidth shortages as work from home becomes a bit more common. Do they become server farms? What are you thinking about in terms of some of these commercial real estate being repurposed or reutilized, and what does that look like as we go forward in terms of taking advantage of it?
Yeah, I think there are huge opportunities there. You look at a place like Seattle where there's a huge housing crisis, or San Francisco, although a lot of people apparently are leaving San Francisco at the moment. But take Seattle, where no young person or middle class person can really afford to buy a house in the city. But at the same time now, like you probably have a lot of office buildings that aren't going to be fully staffed back up. So, turning a full blown office building into mixed use or even just apartments, I think there's a lot of money to be made from just, wholesale repurposing, like the malls, turning those into fulfillment centers. I'm sure you could turn a lot of those kind of things if if you had the right climate and everything for data centers. So I think the smart money in the commercial real estate realm and the private equity side is probably looking at how they can go and change the function of a property to kind of take advantage of the shifts we're seeing right now. Although with that said, I think this whole death of the office and everyone's going to leave the cities and, live in the countryside. I think people are extrapolating that too hard and taking it too far. So whenever we actually get to a bottom in this thing, I think just buying pure office at some point will actually be a solid opportunity. If you read the headlines, no one's ever going to work in New York City again. And I would buy a bottom in New York City at some point, that's fine.
Oh yeah. Pass it on to the kids. All I know is that I'll go back to an office as long as it's never an open floor plan, unless I'm a trader, because open floor plans are just the worst when it comes to, just generating camaraderie or whatever it is. It's just bothersome in the sense where you end up having headphones on, you get annoyed at someone who's talking too loud. So it's an interesting setup because like here, working from home really isn't an option because I have 3 kids. There's really but I still need to get out, so I have office space. So it's an interesting setup in terms of maybe if people work from home, it's rather not working from home, but closer to home. And there's that repurposing in terms of some of those components where you kind of, divvy them up and split them up into smaller offices for people. So no, it's interesting. Well, Chase, it was a pleasure having you on. Thank you so much for coming. Any last words you want to leave everyone with?
No, just if anyone wants to find me, Twitter at PaaniqMacro and PaaniqMacro.com.
All right. Well, thanks again. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Thanks again.